The US unsecured loan market valuation is $3+ trillion. Now, if you add private credit and other forms of business loans, the number gets a lot closer to $10 trillion. So that makes me think, like, what's stopping stablecoins from dominating these markets in the next 3 to 5 years? Because we have already established that stablecoins are cheaper, faster, and a lot more transparent than what a traditional finance market currently is. And yet, we haven't really managed to put forward a single solution that effectively handles unsecured lending in DeFi. Now, I mean, you can clearly see that figuring out a way to do unsecured lending on chain will open up a multi-trillion-dollar industry in crypto. But to do that, we need to first answer a few questions. For example, how do we define or determine the creditworthiness of a borrower? What legal recourse do we have in the event of a default? What regulations do we have to follow, or under whose jurisdictions does this whole thing come under? Right. I will try to answer these questions in today's episode and understand how far away we are from having a fully functional unsecured DeFi lending market. Now, one of the critical indicators of market maturity is obviously the convergence of yield, where you don't necessarily have like a huge mismatch or an arbitrage opportunity. Like, for example, in previous cycles, on-chain borrowing costs were often, like more often than not, like completely disconnected from what the Fed's fund rate was and what basically the speculative demand of leveraged trading was in DeFi. So based on that, like the Fed's fund rate could have been around, I don't know, 4 or 5%, whereas the DeFi yield could have been around 20%. So that's a huge difference, which makes it basically instantly incompetitive for people to actually use DeFi loans for business purposes outside of trading. Now, recently, if you there was a new Visa white paper that came in on-chain lending opportunities, and they listed out basically they shared a chart where if you look at it, like the lending interest rate stabilized at around 5.1% APY, while borrowing costs averaged around 6.4% APR. And like if you compare to historical averages, that's obviously the demonstrative stabilizations.
So now we are almost seeing like borrowing costs compressed to like 6.4%, which is competitive with like traditional banking lines. So the problem, it looks like it isn't economic anymore. It's now about like, uh, let me start again. Did I do anything wrong
No, 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 you
while
you
I'm
did.
speaking?
Yeah, the second one,
Yeah,
second
it
line.
reads
Then
very GPT, by the way. That's why I stopped in the middle. It reads very GPT.
the second sentence I wrote that, not GPT.
So the problem isn't economic anymore?
Yes.
Okay.
Okay, it's now about no. It's not now dependent. It's now dependent on technical. Okay, yeah, it was grammatically
Problem
incorrect.
doesn't look so the problem doesn't look economic anymore. Let's do that.
Okay.
Isn't is very GPT. Anyways, I'll start. So we are seeing now.
All right, all right,
Mhm.
all right, go on.
So we are now seeing that borrowing cost compressed to about 6.4%, which is now competitive with traditional banking lines. So the problem doesn't look economic anymore. It is now dependent on technical and legal considerations.
Yeah, yeah, exactly. I mean, if you look at like when on-chain rates were 15%, no traditional business would borrow on-chain. Like at 6.4%, on-chain capital becomes the competitive with bank lines of credit, as you said. Particularly for borrowers in jurisdictions where local currency volatility or banking friction adds up basically a premium to the cost of capital. Now, the narrowing the narrowing spread basically suggests that on-chain credit markets are becoming efficient. There are obviously opportunities of arbitrage for different traders and institutions, but overall, the market looks a lot efficient now than it was a couple of years ago, even, right? So the primary problem right now, and as it has always been with unsecured on-chain lending, is debt trade-off rate. Like in the event of a default, how do you get your money back? There have been like countless DeFi protocols that either got completely crushed or changed their course from unsecured lending to collateralized lending, simply because major borrowers defaulted in a poor market. Like if you look at Mabel Finance, for example, one of the
Mhm.
biggest lenders in DeFi, but they are primarily collateralized. Their products are primarily collateralized debt because like they took a huge hit during FTX, the whole FTX collapse. Yeah, and then they basically haven't really gotten into an uncollateralized or undercollateralized loan in a big way as of now. I mean, they still do offer some products, but it's nearly not not even close to what their actual like collateralized the debt products are. So in this episode, I want to cover protocols like Goldfinch, Clearpool, Credit Coop, Huma Finance, 3Chain, with a special focus on how they approach determining creditworthiness and their debt recovery process in the event of a default. For example, Goldfinch, they represent the other side of the institutional coin, where like lending to real world businesses in emerging markets rather than crypto trading firms. Goldfinch's their original thesis was to provide crypto loans without crypto collateral to fintechs in markets like Nigeria, Kenya, Southeast Asia. So these are basically obviously like subprime markets in general, but very similar to Maple, Goldfinch faced a significant headwind as basically the global credit cycle turned. Goldfinch actually has had a very similar event, default event like Maple Finance, with one of their lenders called LendEast. LendEast, ironically, borrowed about $10 million, and they could only repay about $4 million worth of it. And so this is of I mean, if you look at protocols like this, like $6 million default is a pretty big amount. So in response to this, Goldfinch basically made a pivot in 2025 towards their Goldfinch Prime system, where they started targeting larger and more established credit fund managers. Like, for example, like BlackRock, Crescent, Monroe Capital, etc., etc. So this obviously like this takes them from like the direct SME lending towards the fund of funds model, where basically they, by lending to BlackRock affiliated entities, Goldfinch is effectively they're outsourcing the underwriting and the recovery risk to the world's most sophisticated asset managers.
Mhm.
And obviously, like while this lowers the decentralized nature of the protocol, these are all like permissioned KYC heavy pools. It obviously also drastically reduces the possibility or the likelihood of a borrower default, or even in the case of default, the recovery process is much clearer rather than what you have in the when you are lending in an opaque market basically. And then we have a very similar pattern with Clearpool. Clearpool actually deploys something like Aave with a dynamic interest rate model, where they have where what they're doing is they have an utilization like they are borrowing from Aave's utilization curve, but they're applying it to unsecured loans. So the Clearpool's algorithm adjusts interest rates based on demand of liquidity, and basically in what kind of borrower pools they have and what kind of liquidity demand they have in that pool at that moment. Clearpool is facilitating unsecured loans to borrowers like Hyperrhythm, with an emphasis on the model that eliminates liquidation risk for borrowers completely, because obviously there is no collateral to liquidate. So in exchange, what they're doing is they're significantly making the yield higher for lenders. So obviously you get high return, high risk, high return ratio here. Their primary focus is on the dynamic pools that they have deployed, which allows for more fluid capital markets where rate prices the rates price risk in real time, unlike in something like a fixed term fixed rate loans, which is typical for protocols like Maple or Goldfinch. What I actually found particularly interesting for Clearpool is their auction and insurance process. Now, I looked into went through their documentations to understand how exactly they're doing it, which is like when a pool is in default, so that will automatically trigger an auction that basically the borrower has failed to repay the loan. So now anyone can buy out the debt and basically pursue legal actions on their own against the defaulter. So what happens is basically the pool goes into default, an auction is triggered, then the bidders can individually or institutions, both of them have to be whitelisted, by the way. They can come in, they have to basically provide KYC informations and other business details so that they are whitelisted to and clear to bid. And once the auction is in progress, so and bids are placed, then the users have the option to basically either accept or reject the bid. Depending on what they do, either the users themselves have the right to basically go against the defaulter, or in case of the auction goes through successfully, then the whoever has won that auction now gets the right to basically pursue that defaulter legally. And then what's more interesting is that they have an insurance fund, so which offers the users, the lenders, some sort of a safety net. What they do is, like, each borrower pool has an insurance account. Like, on every block, a governance approved percentage of the pool's interest is diverted to the insurance account. So right now, the current approved parameter for insurance is 5% of that pool size. So that 5% is always set aside for in case someone defaults. So you get paid that 5% back. That 5% gets distributed among the lenders, which is certainly an interesting fix to the default scenario. It obviously doesn't give you, like, make you whole, but there is always a risk and return when you are doing
Mhm.
this kind of high risk. When you're doing this kind of high risk lending operations, right? Now, what's even more interesting than Clearpool is what Credit Coop has done with their Spigot smart contract. So let's take a look at Credit Coop now. So, like, Credit Coop has, like, is probably the most dominant player in this space in 2025 right now, because of their Spigot smart contract. What they're doing with Spigot is, like, think of Spigot like a programmable lockbox that basically solves the enforcement problem in cash flow lending. So, like, in TradFi, you have lending against receivables that involves a complex legal trusts, lockbox, bank account, and manual oversight. But on chain, the Spigot smart contract acts as basically a middleware between a borrower's revenue source and their wallet. Like, so what will they will do is they will escrow a certain percentage of the cash flow, like this, on the borrower's on-chain revenues. So, like, think of something like, all right, I'll get to the example later, but let me just walk through the what exactly happens.
Mhm.
So, like, an escrow on the cash flow, and then it automatically splits the revenue, redirecting a prefixed amount portion to repay the lender, and before the borrower can access the funds. So the borrower essentially gives the Spigot smart contract access to its own cash flow system. So the Spigot goes in, takes its share first, and then the borrower can access its own cash flow. So that's what actually makes it pretty interesting for me.
So when I'm looking at the Spigot smart contract, how does this actually solve the enforcement problem? What exactly happens when there is a default?
So, there is actually a programmatic recourse on the default issue. Like, you don't need to sue anyone to get paid. The code itself enforces the seniority of the debt claim over the borrower's operational
Mhm.
cash flow. So, like, if a borrower defaults, the Spigot can redirect 100% of the cash flow to the lender. So, as I said, like, the
Uh,
Spigot already right now has access to your cash flow when you were using Credit Coop to get any sort of loans, right? So, if you like, there is a grace period, and by which time, if you fail to repay whatever loan or whatever installment that you have to pay on that month, the Spigot basically goes in there and locks you out of your own out of your own cash flow. I'll give you an example. Like, Rain, one of the most popular crypto credit card that we have right now. It's basically unsecured, completely unsecured. The Rain uses Credit Coop. Like, this is a partnership with Credit Coop, Visa, and Rain. So here's what Rain does. Like, so Rain issues corporate cards to Web3 companies. Now, when a user swipes a card, Rain owes the card network, which is Visa in this case, money immediately for daily settlement. Like, however, because it's a credit card, Rain has to wait until the end of the month for the cardholder to pay on that billing cycle. Now, this creates a massive working capital gap because, like, Rain owes Visa every at the end of every single day, whereas Rain is not getting back the money from the credit
right.
card user until the end of the month. So that means, like, there is a cash crunch at all time. The solution for that is Ren uses Credit Coop to borrow USDC to Visa daily, and the collateral for the loan is the future receivables from the cardholders. So
Uh,
Ren is basically saying, like, okay, give me the money now, and I will give you access to my cash flow, because, as you can see, these are the number of people that are borrowing from me, and basically they are very likely to pay back at the end of the month. So that's basically the logic here. And as of August 2025, Ren was borrowing and repaying over $175 million in USDC every single month via Credit Coop. Now, what that means is basically, like, this single use case shows you that the high volatility nature of this this
Yeah.
capital movement. Like a capital is recycled rapidly, daily, weekly, monthly, generating a high aggregate volume with like relatively small pool of liquidity. So like by 2025, Redcoop has already facilitated over $500 million in total volume with zero defaults. Like this completely validates the spigot model that they have, like how robust the mechanism is for securing cash flow based loans, and obviously one of the most innovative solution that I have seen in this industry by a long margin. Now, so let's move on to Huma Finance, which is actually something pretty interesting. If you look at Credit Coop focuses on structured finance and lock boxes, whereas Huma, they have positioned itself as a broader PayFi network sort of a thing. Like they are focusing on cross-border payment financing and global trade finance. Like by April 2025, Huma has surpassed $4 billion in total transaction volume with a run rate of about $10 billion. So you can see like the scale is already there, and the key driver for Huma's volume is its integration with ARF. ARF is a global settlement platform. So in cross-border payments like remittances, there is a liquidity grab because a remittance company in Mexico, for example, needs to pay out pesos to recipients before the dollars from the sender in the US actively like actually settles in the Mexican account. So you are paying right now, but you are still waiting for the dollar to hit your account and settle. So this is
Right.
basically what the pre-funding problem is. Like the pre-funding requirement is extremely capital intensive. So what Huma does is Huma solves this by lending stablecoin liquidity instantly to the remittance provider, and the loan is of short term, like a few hours to a couple of days at max, and is repaid as soon as the cross-border settlement is finalized in the processor's bank account. This generates yields of like 10% or more for lenders through through this rapid capital recycling process. For example, ARF alone processes over $500 million monthly through this system.
And then, how exactly is Huma earning such yields funding a remittance for just a few hours?
So primarily what you have to consider is
Romeo, let me do that again. Let me do that again. I was reading. Is the sentence correct? Funding a remittance. How is Huma earning such
yes,
yields funding a remittance?
yeah, yeah, yeah.
Mhm. How exactly is okay? Wait. How exactly is Huma earning like 10% plus yields funding a remittance just for a few hours?
So you have to look at like the capital isn't locked here. Like when you're talking about 10% annual yield, don't think of that like the money is locked in somewhere. The money is rapidly recycling. So because you are earning the same yield over and over again on the same amount of money.
Ah,
So you're basically just recycling the capital here. That's why the 10% yield is like so effortless here. Like I could easily see them making 15-20% in some cases, because it's just because they have that flexibility to lend that same money again and again, without taking a lot of risk on defaults. So yeah, that's what's happening here. There's actually another category, which is the most ambitious and experimental of all of these unsecured lending systems, which is like enabling unsecured credit for consumers, small entities, and traders who don't have like robust, often legal structures or massive revenue streams to lock in a spigot. And this is actually the one that I care mostly about, and that this is where we have made the least amount of progress so far. Because this requires solving the identity and the reputation problem on chain without violating privacy. So that's where actually 3gen comes in. 3gen, what 3gen does is they're attempting to bring the unsecured line of credit to the individual or small traders by leveraging this technology called zkTLS, which is zero knowledge transport layer security. And what this does is basically they are addressing the privacy verification paradox, which is like borrowers have data like bank balance, credit score, and trading history,
correct.
which proves that they're creditworthy, but they cannot put that data on a public blockchain due to privacy and security concerns. Obviously, you don't want your financial details to be available to everyone on a blockchain. So
Mhm.
what they're doing exactly is like using zkTLS. What they're doing is like they're generating a proof of their off-chain data without revealing the data itself. Like so, what you are doing, so for example like you connect your bank account or your sex account like Coinbase or Binance to their browser. The zkTLS protocol goes in there, looks into everything, it satisfies their requirements, and they basically come out and on chain say like, okay, it either satisfies our requirement or it doesn't. It's either true or false. If it's true, then you move on to the credit issuance process, where the protocol issues a credit line in USD3, which is a like sort of like a stablecoin credit token backed by the proof of loans. So what's interesting here in the case of a default for 3chain is they auction off, like very similar to Clearpool, they auction off the bad debts to some collection agencies. Like what collection agencies do is like they will buy the bad debt for like 5, 10, 15 cents on the dollar, and then they will pursue the defaulters themselves legally, or basically through whatever means necessary, depending on what jurisdiction you are. So that is some sort of a recourse, because I mean obviously you don't have a lot to do when like a credit card holder defaults. Like if someone declares personal bankruptcy, there isn't a lot of recourse that you can go otherwise basically just going to the defaulter and trying to negotiate something that doesn't leave you with completely zero money. But again, that's the industry that you are in. If you are lending to a high risk demographic, that's the risk that you have to be okay with. But this is a system that I find quite interesting, and I would like to see what, like how far they can go, or how widely they can scale in a when they are managing billions of dollars instead of just a few millions of dollars that they have right now. Very similar to 3chain is uh, Credora. Actually, Credora actually got acquired by Redstone recently. So what Credora does is they have established itself as like a leading provider of privacy preserving credit computation for institutions. Like the technology is like their infrastructure. They monitor borrowers' positions across centralized exchanges, custodians, and DeFi protocols in real time, and then based on that information, they calculate a risk score and an implied probability of a default, which is basically an on-chain credit score. And then they provide that information to DeFi protocols like Morpho, Spark, or anywhere else, where you can, whenever someone is basically borrowing from your market, you can see like how like how dependable they are, depending on this kind of credit score that you have, which is again like pretty interesting. The last protocol that I want to talk about is Wildcat. They're actually backed by Wintermute, one of the biggest entities in crypto, and pretty controversial one at
Right.
that. So they actually represent a very niche but philosophically important experiment in this bucket, which is like they call themselves like banking but worse, because what they do, like this like on-chain credit lacks the protection of traditional banking. So their model is that like Wildcat will allow borrowers to create their own banks or credit facilities where they set the terms. Like you get to set your own terms. For example, collateral ratio, interest rate, lender whitelist. There is no protocol delegate acting as middleman. So everything is on
Mm.
yourself. Like you are doing the due diligence yourself. Like lender, as the lender, you have to do your own due diligence. Now, if you trust Wintermute, you can lend to Wintermute's own pool on Wildcat. And if they default, you have no protocol insurance, you have nothing, no legal. You do have a legal claim against Wintermute, and you can default. You can pursue them.
Right.
And actually, this has been quite a successful experiment so far. Wildcat actually has already generated $368 million plus in credit, so that proves that there is some form of a proof of concept that is that they have been able to establish. Now, from here on, we will have to see like how far they can go. Like, but it's Wintermute, so I have a full faith in them that it's going to go at least
Hmm.
somewhere. Either it's going to spectacularly blow up in your face, or it's going to like cross a few $1 billion in the next couple of years.
Right.
Like it will be quite interesting to see. Like in general, again and again, what I'm seeing in these protocols is the metric of success in 2025 has fundamentally shifted from a total value locked to total transaction volume.
And what makes you say that?
um okay, so look at a couple of things. Okay, like if you look at like Maple's $1.9 billion setup USD, it's pretty significant,
Hmm.
but it represents a static capital that is held for yield, in contrast to Huma's $4.5 billion volume and Credit Coop's $175 million monthly flow with Rain. That represents a sort of like a true unlock, if you say, in monetary
Right.
capital. like because the capital is moving through the system to finance real economic activity. Actually, one more thing that I want to mention is TVL can be manipulated quite heavily. Like if you are in crypto, you know very well how DeFi protocols basically just get people who rent their own TVL in their
Right.
protocol for incentives or for airdrops. Which just after the TGE, when the airdrop is distributed, you will see like a $4 billion, $5 billion drop in a single day. That clearly shows you that they're just simply TVL farming for the incentives. So TVL is has basically lost all credibility in terms of how reliable a protocol or platform is based on the TVL number. But if you are processing a significant amount of volume on a daily or monthly basis, that basically shows that you have got a product market fit. There is a number of people who actually use your product on a day-to-day basis, and there is no incentives attached at all. And then there is also the velocity concern, where like the money is moving every single day, which again shows that you can scale, that there is a real demand, and the technology is robust enough where you can handle such a huge volume without breaking down or without experiencing some sort of a security breach.